In this video, we're going to talk about what journal entries to make when your firm collects an accounts receivable that was already written off, that was already deemed uncollectible, and how you would go about reversing that. So let's take an example. Let's say that your firm is a clothing store and you extend credit, your firm extends credit to credit-worthy customers. Someone buys a dress, but then they don't pay $50. Right? They owed you $50 for this dress. They don't pay, so then that's uncollectible. Let's say they went bankrupt. So they go bankrupt, and what journal entry are we going to make for this non-payment of $50? Well, we're going to debit allowance for doubtful accounts. Allowance for doubtful accounts. And why are a debit is going to decrease allowance for doubtful accounts. And why are we debiting this? Why are we decreasing it? Well, because allowance for doubtful accounts was an estimate, and we're past the estimate stage. This person went bankrupt. They didn't pay us the $50. So now we have to reduce account receivable directly with a credit. Remember, it's an asset, so it goes down with a credit. We reduce account receivable, and then we reduce our estimate account here, our allowance for doubtful accounts, because it's no longer doubtful. They in fact didn't pay. So that's what happens when they don't pay. So let's just put that over here. This is when they didn't pay. But now here's the catch. In this case, the person actually goes and let's say they win the lottery. They win lottery and they decide to pay. They win the lottery and decide to pay. So you collect, you get the $50 that they owed you. They give you $50 cash. They say, I'm really sorry about this. So how do you account for this? Right? Because you've already written this off, right? Here's the write-off. You reduced account receivable, you reduced your estimate. Well, what you do is you first just back that out. You just reverse the entry. So it's actually pretty simple, right? We reverse the entry. We just flip it around. So now we're going to put the receivable back on the books. We debit account receivable for $50. And then we credit, and I'll just put ADA here, allowance for doubtful accounts. Now we credit that for $50. Right? We just reverse this entry. And what's the reverse in the entry do? It basically makes it like this never happened. Okay, but now we have to make another entry, because the whole reason we did this is because the person came and gave us $50 cash. Now, we had written that off. We thought, well, we're never going to get it. But we did get it. So now we actually have to account for that as well. So we're going to have a debit to cash to reflect the fact that we received $50 cash. And now we're going to credit account receivable, right? So $50. So we've actually got a couple things going on here. And now you could combine these two receivable entries into one if you wanted to, but I just kind of did it like this just to make it easier to understand. Basically, you reverse the entry, you reverse the write-off to put the receivable back on the books, and then you account for the cash that you collected and reduce the receivable accordingly.